In 1962, a retired IRS auditor named Ann Scheiber walked out of her office for the last time with $5,000 in savings and a plan. 33 years later, she had turned it into $22 million. She never sold a single share. Most investors think of dividends as an afterthought, a quarterly bonus, maybe 2%, maybe 3%, nothing exciting. But here's what they are missing. Dividends are not just income. They are a share of a real, living business's profits, paid directly to you, the owner, simply for holding the stock. When a company like Johnson & Johnson sends you a dividend payment this quarter, it is telling you something important. We made money, and as a shareholder, as a co-owner, you deserve your cut. That is ownership income, not speculation, not hope. Ownership. Now here's the extraordinary part. The companies that have paid dividends consistently for decades, the so-called dividend aristocrats, have increased their dividends for 25 or more consecutive years. Through recessions, wars, pandemics, and every market crash in between. There are 68 of these companies on the S&P 500 right now, and they have collectively outperformed the broader market over 30 years. Not by being exciting, by being reliable, by rewarding patience. Here's where it gets extraordinary. The S&P 500 has returned roughly 10.5% per year over the long run. But did you know that more than 40% of that return, historically, has come from reinvested dividends? Not from stocks going up, from dividends being reinvested to buy more shares. If you had invested $10,000 in the S&P 500 in 1994 and collected your dividends as cash without reinvesting them, you would have roughly $75,000 today. But if you reinvested every single dividend through what is called a DRIP, a dividend reinvestment plan, your $10,000 would have grown to over $200,000. Same stock, same market, a $125,000 difference. That is the power of compounding income. The rule of 72 gives us a quick way to understand this. Divide 72 by your annual return, and that is how many years it takes to double your money. At 7% returns, your money doubles every 10 years. At 10%, every 7 years. But when you reinvest dividends, you buy more shares. Those shares pay more dividends, which buy more shares. You are not adding, you are multiplying. Einstein reportedly called compound interest the eighth wonder of the world. In investing, dividends are the engine that makes that wonder run. Let's talk about the most famous example in investing history. Warren Buffett bought 400 million shares of Coca-Cola through Berkshire Hathaway. He paid $1.3 billion. He has never sold a single share. Today, that position is worth over $24 billion. But here's the part the financial press does not lead with. Berkshire now receives over $700 million every year in Coca-Cola dividends alone. That is more than 50% of the original purchase price, every single year, in cash. Not from selling, not from timing the market, just from holding. Coca-Cola has raised its dividend every single year for 61 consecutive years, through stagflation, through the dot-com crash, through the 2008 financial crisis, through COVID. Every year, more dividends. Buffett understood something most investors still struggle to see. The best dividend stocks are not just income sources. They are compounding machines disguised as boring consumer brands. Procter & Gamble, Johnson & Johnson, Realty Income. These are not exciting businesses. They sell shampoo and soap and real estate leases. But they have been making their shareholders richer, quietly, every single quarter, for decades. Here's where most investors destroy their own dividend machine. The market crashes. It always has and it always will. The S&P 500 has lost 20% or more of its value, 12 times since 1950. Each time, the financial media declared a crisis. Each time, retail investors panicked. And each time, the investors who did not sell came out ahead. In 2008, the S&P 500 dropped 57%. That felt catastrophic. But dividend-paying stocks held up better, and the investors who kept reinvesting dividends through the crash, buying more shares at bargain prices, saw their portfolios recover faster and ultimately reach higher highs than before. Think about what a market crash actually means for a dividend investor. If you own 100 shares of a company paying a $1 per share dividend and the stock price drops 50%, your dividend income has not changed. You still receive $100, and now your reinvestment plan buys you twice as many shares with the same dividend payment. Crashes are not disasters for dividend investors, they are sales. The worst mistake you can make, and most people make it, is selling when prices are low and buying when prices are high. Dividends give you a reason to hold. They give you a paycheck that keeps arriving, regardless of what number is displayed on your screen. So how do you start? The first thing to look for is not yield. A high dividend yield can actually be a red flag. If a company's stock price has fallen sharply while its dividend stays the same, the yield looks attractive on paper, but it might signal that the company is in trouble, and the dividend could be cut. Instead, focus on three things. First, dividend growth rate. Has the company raised its dividend every year for 10 or more years? That consistency is your best signal of a healthy, profitable business. Second, payout ratio. What percentage of its earnings is the company paying out as dividends? Below 60% is generally healthy. Above 80% could mean the dividend is unsustainable. Third, free cash flow. Does the company generate enough real cash, not just accounting profit, to cover that dividend comfortably, even in a difficult year? Companies like Microsoft, Apple, and Home Depot have all become dividend growers in recent years, adding to the pool of quality income stocks. And you do not need to pick individual stocks at all. Low-cost dividend ETFs like VYM, SCHD, or VIG give you instant diversification across dozens of quality dividend payers for a fraction of a percent per year in fees. Start small, reinvest everything, check your portfolio once a quarter, not once a day, and do what Ann Scheiber did. Be patient. The machine builds itself, but only if you let it run. 33 years ago, Ann Scheiber made a decision that changed everything, not by being smarter than everyone else, not by timing the market perfectly, but by understanding one simple truth. The best investment is not the one that makes the most noise. It is the one that keeps paying you while the rest of the world panics. That is the dividend machine. If this video gave you even one insight you will carry forward, subscribe to Market Mapped. We do this every week. Real analysis, real stories, real value. Hit the notification bell so you never miss one, and leave a comment below about which dividend stock or ETF you are currently watching. We read every single one.